spent a whole video talking up the 3-fund portfolio and going on and on about how it's the king. While I still believe it to be true, I should have put a little Barry Bonds asterisk by that statement because there's a portfolio that I like a lot more. 85% of my viewers are over the age of 25, so hopefully that reference wasn't too obscure. The portfolio that's a good alternative to a 3-fund portfolio is the 2-fund portfolio. So let's talk about why that is and when it might make sense to use it. As a little bonus, I'll also answer the question of when it does and doesn't make sense to rebalance either of these portfolios. Think of the 2- and 3-fund portfolio like co-emperors. One of the emperors would run the show under certain conditions, and the second emperor would run the show under other conditions. Kind of like when the more reserved, stoic Marcus Aurelius and his younger, more aggressive brother Lucius ruled Rome at the same time. I say that one is a more aggressive portfolio, while the other is more reserved, because the assets that are held within each one. The 3-fund portfolio is made up of a total US stock or S&P 500 index, a total international stock index, and a total US bond index as well, while a 2-fund portfolio only holds 2 of those 3, the total US stock or S&P 500 index and total international stock index. Of course, more stock-based funds equals a more aggressive portfolio. Here's an easy list of potential 3-fund portfolios from Vanguard, Charles Schwab, and Fidelity. If we're talking about the 2-fund portfolio, then all you do is hack off the bond index fund from that list. Bonds are the only thing that makes these 2 funds different. I know, some of you may be thinking, with interest rates and inflation on the rise, bonds are absolute trash, so there's no reason to hold any of those things. Wrong, wrong, and wrong. Yes, rising interest rates are bad for bonds. Yes, high inflation is bad for bonds, but they still make sense to hold within a 3-fund portfolio, and we'll cover why that is later in this video. Even though the 2- and 3-fund portfolios are very different, they have quite a few shared benefits. The first is that the stock portion of both hold a total of 11,768 stocks for companies spread across the world. This instantly diversifies your money among different companies, sectors, countries, and even currencies. You might come across headlines about how diversification can be an investor's worst enemy, but in reality, it's going to reduce your risk of being overexposed to any of the different factors that I just mentioned. Because you have one US stock fund to handle the companies based there, and one international stock fund to handle the rest of the globe, there is zero portfolio overlap. Portfolio overlap happens when you invest in multiple funds that holds the exact same stocks. Having too much fund overlap can reduce your diversification, and it isn't so obvious if you hold a buttload of random funds that hold too many stocks for you to keep track of. Before you try to cancel me, yes, a buttload is in fact a real unit of measure, so get your mind out of the gutter, you freaks. Even if it wasn't, I'd probably still use the phrase because a buttload has a nice ring to it. A simple example of portfolio overlap would be if you held something like the Vanguard Total Stock Market ETF and the Vanguard S&P 500 ETF at the same time. Since the total US stock ETF holds literally all of the stocks within the US, the 500 stocks that are held within the S&P 500 are going to already be in VTI. This would cause a 99% overlap of VOO's holdings within VTI's holdings. Therefore, it doesn't really make sense to hold both of these funds at the same time because you just end up concentrating more money into those 500 companies without even realizing it. Time out though, because I need to give a quick disclaimer about what I just said. This exact example is probably the least problematic because having more money in those top 500 stocks isn't going to destroy your diversification. It was the simplest and most straightforward example to get my point across. If you have a choice, then pick one or the other, but if you invested in both, then you'll be perfectly fine. Portfolio overlap is more problematic when we're talking about holding a fund like the Vanguard S&P 500 ETF and the Vanguard Growth Index ETF. That's because 65% of VUG's holdings are already held within VOO, which is pretty darn high. If you invested in both, then you'd have more money allocated to those 166 overlapping stocks. I'll have my VTI versus VOO video linked at the end of this video and in the description as well. But of course, wait until the end of this video before watching it because we need to talk about saving some money on your investments. If you're enjoying this video so far, then help support my dog Molly, who is actually laying at my feet right now, waiting for me to get done filming so we can go outside and play by hitting that thumbs up button. Like I said, it does help support her as well as this channel. Both the 2 and 3 fund portfolios are extremely cost effective as well. For every $1,000 invested into the Vanguard ETF versions, you'd only pay 30 cents every year for the total US stock index and 80 cents for the total international stock index. Compare that to the $7.50 you'd pay per year for every $1,000 invested into an expensive, actively managed fund like ARK. Even though I usually don't do public math, I'll make an exception for you right now. A Vanguard total stock market ETF is 25 times less expensive than the actively managed fund that charges 0.75% per year. Because these 2 and 3 fund portfolios track an underlying index, they're not relying on a fund manager to successfully buy and sell stocks that are held within the fund. This immediately reduces the fund manager risk associated with actively managed funds. Any professional investor is trying to outperform one thing: a benchmarked index. Now, this could be something like the S&P 500 or the total stock market index. But a fund manager can't do that without taking on additional levels of risk. A good example of fund manager risk is the psychopath fund manager that runs the ARK investment funds, Cathie Wood. Now, I'm sure on a personal level, she is a very nice gal, but on a professional level, she is a big-time swindler. At one point, she said that her fund would deliver a 40% compound annual rate of return during the next 5 years. Her fund is already down around 40% this year, so if she wants to hit that average 40% per year, she's got a lot of catching up to do. When someone claims they can get you this type of return, you should run for the hills, because that's not only delusional to think, but even more arrogant to say out loud for the world to hear. That claim is the definition of a red flag. Just like an ex-girlfriend secretly stealing a pair of my house keys was a red flag as well. Wait, because we have breaking news. Cathie Wood actually upped the ante. She said she's now estimating her future annual returns at 50%. This means she's saying that if you invest $10,000 into one of her funds, then in 5 years, that'll grow to $76,000. That is insanely stupid. If something sounds too good to be true, then it probably is. Avoiding fund manager risk like this is what you're trying to avoid by investing in something like a 2 and 3 fund portfolio. The 2 and 3 fund portfolios are kind of like the Raising Cane's of fast food restaurants. If you've never been, they offer 4 items and nothing else: boneless fried chicken, crinkle cut fries, coleslaw, Texas toast, and their cane sauce. Less decisions makes everything so much easier. Rebalancing for both portfolios is simple. Allocating money across those small amounts of funds is simple. Withdrawing money from a couple of funds is simple. And removing all decision making when it comes to what to invest in is simple. There's no reason to pay an expensive financial advisor an ongoing 1% fee every single year to manage a 2 or 3 fund portfolio. Simplifying things nowadays is underappreciated, but it makes everything less stressful, increases efficiency, and frees up your time. The only thing that makes these different is that the 3 fund portfolio has an allocation to a bond fund, while the 2 fund portfolio does not. Some of the most ignorant comments I've heard over the past couple of months in the comment sections of my videos is that bonds are dead, so you shouldn't own them. Because interest rates have increased and we expect them to continue, bonds are in a bad place right now because that causes their value to go down. To top it off, inflation is crazy high right now at 8.5%. This means if your bonds are only returning 2.5% and inflation is 8.5%, then you're getting a negative 6% real rate of return on your money. On the surface and looking at it in this snapshot of time, yeah, that's bad. But 2 things I need to mention to defend the bond portion of a 3 fund portfolio before I tell you when not to use it. Number 1, our mindset needs to be the same with bonds as it is with how we think about investing in stock-based index funds. As a long-term buy and hold investor, what's happening to our investments in the short term is irrelevant. From January 1988 through November 2020, whenever monthly equity returns were down, monthly bond returns remained positive about 71% of the time. Based on current returns, investing in bonds might not look appealing right now, but always remember that we're investing for decades and not days. Number 2, bonds still serve the same purpose in a portfolio: to reduce volatility from the stock-based index funds that we hold. Where else are you going to put that money to replace bonds? Are you going to speculate by putting it into gold? Or how about cash, where it's guaranteed to get eaten away by inflation? It doesn't make sense to throw the money into dividend stocks either, because those are tied to the stock market volatility just as much as your index funds. And don't even get me started by saying that Bitcoin can replace bonds bonds like some people have in the comment sections of my videos. Bitcoin is more volatile than stocks, which is where you definitely don't want to put your bond allocation. If you have an allocation to bonds, then stay the course and ignore the noise. People like us don't freak out about things like this. We sit back and we remind ourselves how in 10 years, we're going to look back at this point in time and laugh at how the irrational people were flipping out and running around with their hands in the air like the sky is falling.
Run for your lives! Everyone run for cover! You're all in danger!
As much as I just talked up bonds within a 3-fund portfolio, I'm about to do a 180 and say that if you're younger, then a 2-fund portfolio could make a lot more sense to use. Insert another Barry Bonds asterisk right there. The younger you are, the more stock market volatility is your friend. By younger, I'm talking 7+ years away from needing the money to live off of. I'm personally not a huge fan of putting any money into bonds as long as you're in the accumulation phase of investing, because doing that is going to limit the upside of your investment returns. Investing in a simple 2-fund portfolio made up of a US stock fund and international stock fund, then eventually transitioning into a 3-fund portfolio later down the line is more ideal. That being said, if you're someone who is younger and feels comfortable having a little bit of money allocated to bonds because it fits your investment behavior a lot better, then there's nothing wrong with that. Is it ideal from a return perspective? Absolutely not. But the more important thing is to build a portfolio that we can emotionally hang on to during the good and bad times. One question that's always been up in the air for me is whether or not it makes sense to rebalance a 2 or 3-fund portfolio. I always thought it made sense to do because you want to stay as close as possible to your stock and bond allocation. Then I heard Jack Bogle, the founder of Vanguard, share his thoughts on it.
But having some stability without automatically rebalancing, I don't think you need to do that. But the less you rebalance, the more you're going to have, because you're always selling the better performing asset.
I am a huge fan of Jack Bogle because of what he did for average investors like us. I even have a tattoo of his face on my head. You just can't see it because I have hair right now. But I wanted to see if what he said held up based on back testing, rebalancing versus not rebalancing a 2 and 3-fund portfolio. Quick disclaimer before I show you the results, these past returns don't mean things will play out this way going forward. It's just a way to give you something to think about when evaluating the decision for yourself. Here are the stock and bond allocations I used in the back test. Changing any of these would change the results, so keep that in mind. For each portfolio, I invested $500 per month, adjusted for inflation, and ran it from 1987 through the end of 2021. Rebalancing annually, the 3-fund portfolio ended with a value of $2,092,000 and a 9.75% annualized return. The 2-fund portfolio ended with a value of $2,297,000 and a 10.15% annualized return. Not too bad of an outcome for either one. I'd personally be pretty happy with both of those results. Now let's test Jack Bogle's suggestion of not rebalancing the portfolios. Since contributions are being made monthly, anytime the 2 or 3-fund portfolios move away from our target allocations, the contributions will be invested in the ones that are underweight to get them back up to where they need to be. If you think about it, this is technically a form of rebalancing, but just not in the traditional sense of the term. Not doing a traditional rebalance, the 3-fund portfolio would have ended with a balance of $2,373,000 and a 10.16% annualized return. For the 2-fund portfolio, the ending balance would be $2,535,000 with a 10.48% annualized return. Here's a quick side-by-side of the 2 and 3-fund portfolios. And it looks like Jack Bogle has been right so far, but going forward, who actually knows what's going to happen? Either way, it's probably not going to make or break your returns over the long run while you're still contributing money every single month. If you hold these funds in a taxable account, then it probably doesn't make sense to do any rebalancing, because when you sell off your winners to buy your losers, you're going to pay capital gains taxes, so I'd probably avoid it in this type of account. Please hit that thumbs up button to help support my dog Molly and of course this channel. In the description, I will have a link to join the private financial independence community as well. To your left, check out the video on how to invest your next $1,000. I'll see you in the next one, friends. Done.